Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to a webcast of InFocus. Joining me today is Brian Durno, our Chief Investment Officer. Welcome, Brian.
Thanks, Mike.
And we're here to do an investment overview. Folks, if you're listening on an audio platform, we're going to step through some charts. So I'd encourage you to, hop onto your favorite platform and have a look at those charts. But if you can't, don't worry about it. We'll do our best to describe it. All right, Brian, why don't we jump into this? We always, let's start off at the macro level. So I'll right away start with the first chart here, and we'll look at what's been going on with both the U.S. and Canadian banks and in interest rates.
Great, that's a great place to start, actually. It's been quite a busy week on the macro front. So what we're showing you here, we went all the way back to 2006 just to kind of give you a guidepost of how closely related the Canadian bank rate and the Federal Reserve's bank rate is. And you can see there, like over the last number of years, they're very, very tightly clustered together. And of course, that's partly because they have the same inflation target. But you'll notice in the last more recent period since 2024, there's been a pretty big divergence between the two rates in Canada and the States. And that you'd have to go back almost 30 years to see that level of divergence between the two bank rates. So Canada sitting around 2.25%. And the Bank of Canada pretty much has argued that they're at the low end of the neutral range. So they're talking about not making any more changes to interest rates unless, of course, there's some policy reason or response to some macro event. And the federal, so we're, let's say, at the bottom end of neutral in Canada. And in the US, they're still not into neutral territory quite yet, flirting up there with 3.75 to 4% is their range. And one thing I might notice, just because it happened, both banks actually cut rates on the same day, which is really quite exciting for us market watchers. It doesn't take much for us. But the odds, so Chairman Powell came out in the press release in the conference and talked about the December rate cut that everyone is wondering what happens next is not a done deal. Those were his words. So right. The odds of a rate cut in December dropped from about 92% after that comment to about 63%. So, and the market was a little bit surprised by his commentary in December. But we'll keep watching this as it unfolds.
And obviously, one of the several factors that may drive the actions of the Federal Reserve and Bank of Canada is what is happening from an inflation perspective. So yeah, let's look at this chart.
Yeah, and this is exactly what we were talking about, how, the reasoning why the bank rates are tightly clustered together is because the inflation experience has been also tightly clustered around that 2%. That is up until COVID. And that experience, you can see the massive bump there in the inflation rates in both countries. But normally that combination is pretty tight. And you can see right where you've drawn that yellow line pretty much. We've had, let's say, a relative increase in the rate of inflation, but we did go down to below 2%, which was the target rate for the Bank of Canada. So we slipped below that level, whereas the American side of the economy hasn't actually dipped below 2 quite yet. But we've been on this sort of upward trajectory for the last few months, but we are still lower than the U.S.
So with respect to the economy and the U.S. versus Canada, another interesting one here is unemployment. It's interesting to look at the differences between the U.S. and Canada.
Yeah, we decided to really only show you 5 years because we have that massive bump from COVID. And most economists, when you're usually, let's say, comparing historical data, you almost have to exclude that period of time to get some historical reference. But our unemployment rate in Canada has been on pretty much a steady march upwards since around the mid of 2022. But that rate of 7.1 is about the highest it's been in 10 years. And there's also been some weakening in the U.S. economy. Of course, we don't have all the federal employees working, so we haven't been able to get a September jobs number. So we've been using some of the private sector data that look like there's a little bit of weakening, but it's kind of mixed in terms of the, let's say, the trustworthiness of all that data. So we're waiting with bated breath to see the actual numbers.
So then bringing those numbers and the like in terms of the activities and looking at how the bond markets are reacting. So this is a good view from a 10-year perspective, and it's interesting to, again, compare the Canadian 10-year bond versus the U.S.
Yeah, that's right. And we're showing you the 10-year yield for both Canada and the U.S. and the US is in the green and Canada is in the blue. But what's really neat, if you think about that earlier slide of how fast the central banks sort of cut rates at the short end, there was a lot of the action in the bond market was happening in the short end of the curve. And if you look out, at least for the last couple of years, in the 10-year part of the curve, it's been actually remarkably stable on both sides. Now, there's been some fluctuations within a reasonably tight range there, but the 10-year story is a much different story than the short-term part of the curve. And we watched this after the budget on the Canadian side of the border here, wondering if there'd be any major impacts here. And so far it's been relatively muted response both on the 5-year and the 10-year side of the Canadian bond curve.
So then looking at spreads of Canadian corporate credit versus the government.
Yeah, this is a great metric to get a sense of the comfort level in the credit markets of taking risk and lending money to investment grade companies. And you can see these spreads. So whenever you lend money to a company, there's always a risk that they don't pay you back. So in order to be compensated for that risk, you earn a spread over the risk-free rate, which you'd call, like, say, a Government of Canada bond. So that's what this is showing you, is how that spread fluctuates over time. And you can see, after the Liberation Day, there was a little bit of a spike up there in spreads, but not that big. So the bond market stayed, let's say, relatively benign through this period. And the credit markets tend to have really only one thing they're worried about: getting their money back and the level of interest rates and how they change during your holding period. But so spreads have kind of given us the signal that the bond market is certainly not twitchy right now. They're sitting there with very tight spreads.
And one of the things that you and the team had provided guidance to our portfolio managers was starting to add some government debt into the bond side of our portfolios. And correct me if I'm wrong, especially with the spreads tightening so much. I mean, there is that, call it a risk, that the spread may go back to a more, I don't know if normal is the right word, spread level. And so we wanted to provide a little bit of diversification from that kind of effect. So.
Yeah, and that's a good summary of a couple of good reasons why we added the government debt piece. And earning a higher rate of return on government debt than inflation is also another good reason. And you did mention about the risk on the fixed income side, but they also tend to protect portfolios on the equity side. So when equity markets experience volatility, it's not unusual to expect government bonds to perform a little bit better. So it's a nice little anchor for a portfolio.
Yeah, it makes sense. Obviously, to your point, that if you're holding corporate debt and let's say the equities are reacting to market volatility, that may bleed into the corporate side of the debt market, so to speak. And so being in the government side of things can somewhat isolate from those types of activities.
Yeah, that's precise. You can actually even see that in the chart there during COVID, that massive spike up in spreads. That happened in the corporate bond market, but it also had a positive correlation to what was happening in the equity market for the exact same reason, because of the threats of COVID.
Exactly. Cool. So let's move over, if you will, to the equities. I mean, a question we always ask ourselves since good old Liberation Day, south of the border, is what are the impacts of tariffs? And obviously we feel it here. Let's say, for example, our unemployment rates in the U.S., are they impacting the businesses? Who's eating the margin, so to speak, with respect to the tax of a tariff? And so this is interesting to look at from an S&P 500 perspective and the profit margins.
Yeah, and this is a great piece of data we've been watching pretty much since April, pretty carefully, to find out if the tariffs are affecting margins. There's lots of little stories underneath the hood, but this is the S&P 500 as an aggregate, and you can see there the corporate profit margins are still, right around that 12.8% range, which is above the 5-year average. So the margins have been hanging in there remarkably well. And so the margins so far for companies have found a way to pass this cost on through. So I think Goldman Sachs did a survey there a few weeks, maybe it's a month ago so now, of how much companies actually do plan to pass through the cost to consumers. And they're estimating around 50 to 70%. So that's kind of one of the things that will support those margin levels, people paying higher prices.
Right. And then from an earnings per share perspective, what are we staring at here?
Yeah, we're right in the middle of the earnings season. We're probably about three-quarters of the way through or so now, and it's always very useful. This is sort of one of the fundamental underpinnings of the fundamentals of the market, is corporate profits. So I figured I'd just share with you some of that data there. You're looking basically at the annual earnings per share of the S&P 500 as an aggregate. So you can kind of see there's a couple bumps up and down here, but the trend certainly over a long period of time is up. And so far this quarter, we have a lot of very fresh data hot off the press. Um, about 83% of the companies that have reported their earnings have beat their estimates. So that's
Okay.
better than average with respect to other earnings seasons. So far, the average beat, like how much these companies are beating their estimates by, is about 5.3%. So that's just a little bit lower than average. But there has been a raft of earnings reported the last few days, and I wouldn't be surprised that those numbers percolate up. And so then if you were wondering about the growth rate, because that's ultimately what sort of the markets are pricing in is the growth rate of earnings.
Right.
So far, we're looking at about 11%. And like I say, with this raft of earnings, we're probably talking closer to 12 by the time this week closes. So that's 12% year over year growth in earnings.
Wow. So let's bring it over to our side of the border from a Canadian perspective.
Yeah, it's a similar story here for 2025. We sort of are looking at around probably 13% or so growth rate in earnings for the year. The only thing I might point out about the Canadian data is just let's say, incredible growth story of the effect of gold and materials sector in Canada. We've had over 100% gain in the gold subsector in Canada, and the interesting thing about that is that it's kind of a financial asset. So when it has a great year, it doesn't necessarily mean that there's a great deal of jobs produced or a huge
Right.
impact on GDP growth. So it's not quite the same as if it were like manufacturing activity or other big gains.
Yeah.
And for 2026, I might just add, because we're starting to look forward to the next year, and you're still looking at both in Canada and the US, double-digit growth rates and earnings are expected.
And again, are the estimates attributing that still with gold, or do we see any trends that might round that out with something more beneficial to the economy?
Yeah, gold is certainly playing a disproportionate role in the growth
Yeah.
rate and earnings. So that's why it's always very important to look at the individual companies. We're just trying to provide an aggregate to get a sense of, if people were watching markets generally and wanted to know are earnings supporting some of the moves that we've had in markets, you could say at least the fundamental under the hood, the earnings have been growing.
Okay. So let's look at valuation again. Lots has been talked. Well, we're always talking about this, but in terms of the S&P 500 being overpriced or overvalued or the like, and so this is a good summary of trends and over the long term and where we are from a valuation or forward P to E ratio perspective.
Yeah, exactly. That's what you're looking at is the forward price to earnings ratio of the S&P 500 all the way back to 1994. So you got a nice long-term series. The real tricky part there is, of course, it doesn't stay still. You might notice that. The
Right.
valuations in the markets are constantly changing and moving around. That's why it's so very important to be, watching carefully the companies that you want to own and the valuations because they do change quite a bit. But yeah, you're quite right. The valuations in the U.S. are, let's say, elevated relative to their historical norms. They've come off a 10-year period of extraordinary growth in terms of the fundamentals under the hood. But the real question is, of course, what happens in the next 10 years? And that's what the market's trying to price in right now.
And so this is one of those headlines, people may see this as they're reading their newspapers people still read newspapers or online, and yet it doesn't tell the whole story. And I always love this chart of what you and the guys pulled together in terms of looking at it from a sector perspective and understanding that even though the overall market may be perceived as being overpriced, there's still opportunities to be had.
Precisely. That's one of the great advantages of sort of aggregating the market out by sector is that you can look for bargains in areas that might get sort of washed over if you're just looking at the larger average. So this is a great little, this is something we use every day to try to help identify which aisles in the grocery store might have the best bargains. And so if I just explain real quickly, basically to keep it nice and simple, you've highlighted there in yellow, everything in that bottom left quadrant is not only cheaper than the stock market on average, so a lower PE multiple, so lower valuations, cheaper valuations, but it's also cheaper than their 30-year average against the index.
Right.
So that's kind of a combination deal there. You want to be in the bottom left in order to find, let's say bargains. It's a good sort of shopping ground. And you can see 8 of the 11 sectors are actually in that quadrant. So there is a lot of interesting things to do under the hood when you go looking for let's say great companies at reasonable prices. It's getting harder and harder, but there are certainly things to look for in there.
Nice. I love this one. Basically looking at our, from a QSEC equity perspective, what's our dividend track record?
Yeah, and this is one of those sort of, let's say, symptoms of a great business is that they produce profits that are higher than their cost of capital. So let's say value creating. So with that value, it often shows up in dividends, growing their dividends, or a strong balance sheet, or value creating acquisitions, those kinds of things. It gives management a lot of great choices of what to do with that surplus capital. And so if you look at let's say, change in dividends each year by year, you can see it's pretty consistent. Every year we have growth. I might remind folks that in 2015 we had a mild recession in Canada, and we ended up with the next year a growth rate of about 3% in dividends. So even though the markets can fluctuate and go up and down with sometimes random nature, dividends kind of help you pay the bills when you have a portfolio of growing dividends. And if you look at the 5 and 10-year averages, you're sitting around that 8% level. What's really interesting about those levels is that they're also higher than the rate of inflation. So it's like getting a pay raise of about 8% every year.
Yeah, a good testament to the QSEC approach in terms of fact several attributes, obviously many attributes we look for in terms of the definition of quality, but that ability to generate dividends and have the potential to grow them has proven itself quite well over this time period. So that's great to see. And then realizing it today, I think we always look at this, and I think this is something that folks really do appreciate, is looking at, maybe after the Jays, back of the baseball card or hockey card. Yeah, talk us through this one.
Yeah, as a Jays fan, I chose hockey very carefully so it wouldn't bring back my memories of the baseball game. Yeah, so this is just basically a snapshot of the QSEC equities that we have basically populated in our equity pool, which is a very, very good representation of our average QSEC equity. And this is just maybe only a week old or so, but you're looking at the average metrics of the kinds of holdings under the hood there. I just did a simple average, so there's no sort of weightings going on. It's basically just a simple average. And I compared that to a 50-50 blend of Canada and the US markets represented by the S&P 500 and the TSX, the big cap board. So if you look at the return on equity, so the profitability of the companies of our average holding around 23% compared to 16 for the blended average of the two countries. Our dividend yield at about 2.8% versus 1.9, so higher yield, higher quality business. And beta is just a sort of a fancy word for the sensitivity to movements against the market. And so anything less than 1 would mean it generally moves around a little bit less than the market. And so that's, let's say, defensive by having a beta of less than 1 at 0.78. And then you think about, well, those are great characteristics, but you must have had to pay one heck of a price for those kinds of companies. But we actually didn't. The average PE is about 17.4 times compared to closer to 20, well, actually over 20 between Canada and the US.
I just love this slide because, again, it just highlights the approach. We're sitting here buying from, we're purchasing company shares in companies that are returning more, basically returning more per unit of equity, so to speak, for return on equity, paying more dividends, call it less volatile than the market, and at cheaper prices. So great summary of the approach, and good to see that the trends are continuing. So one thing we thought we'd do is have a special topic. We like to do that, and this one was great. I found this very interesting when we both independently kind of saw some results here and thought, yeah, it would be good to put things in context, because obviously, as there always is, lots of call it valid hype and maybe overhyped hype. Is that even a word? But between of technology. But it's interesting to compare something as, quote, exciting, unquote, as technology with something as you consider a little bit more steady, like utilities. So why don't you walk us through these, comparing the two?
Sure. Yeah, and we had to go back over a long period of time to try to get a sense of how these two sectors have behaved over a long period of time. And so we compared the returns here of the utility index. So if you look at the long-term return of the utility index all the way back from 1971 to this year, the average rate of return is about 10.04%. You can see that in the far right circle, about 10.04% per year. And surprisingly, that compares to about 10.67% for technology stocks. So that's usually a little surprise for lots of folks.
Yeah.
That they've generally performed pretty darn close to each other over a long period of time. And if you think about the reasons why utilities have been able to sort of plod along and just kind of slow and steady wins the race, came in second place in this case, as you can see there in the two circles, the price change versus the total return. So you can see the price change of 757% for utilities. And remember, this is back to 1971, so those numbers are going to be awfully large. But the bulk of the total return, which is more like 17,000%, the bulk of that return has come from reinvested dividends.
Right.
Which are, of course, much more plodding and slow and steady, and often not very exciting. But you can see the difference there on the price change for the technology sector has been primarily that's what's been responsible for that massive gain in technology has been the price change. So there's nothing, it's not like one is better than the other. They're just very different ways to get to the promised land.
And I think that's the point, being different and yet looking and comparing the results. So this is a good way to look at it by decade.
Yeah, I'm just realizing that it looks, if you take the decades, there's 6 decades shown to you there, and it's actually 3 games to 3. So maybe my Blue Jays memory has not been forgotten this year. But yeah, you can see there like the difference between the technology-oriented NASDAQ and the Dow Jones Utilities Index. They're very, very different, let's say, experiences each decade by decade. And actually, this isn't a terrible thing to have when you're thinking about portfolio construction. You don't necessarily want all of your portfolio sectors to be behaving exactly the same way at the same time, because it can introduce some risk that if the cycle turns against you, you might be on the wrong side of it. And you can see that in the decade of the 2000s, where the NASDAQ was down about 4.9% per year for the decade, compared to plus 7.4 for utilities. So it's just very interesting when you think about portfolio construction. We do this all the time. Really what you're looking at in that decade of 2000s is negative correlation. One thing was up, the other thing was down. And these are kind of very important building blocks to portfolios. And so when I saw this data, I thought I'd really want to kick it around a little bit. And I think it might even be on our next slide, but I wanted to talk a little bit about correlations.
Yeah, diversification, correlation. Yeah, let's look at that.
Yeah, and this gets us awfully excited when we think about portfolio construction, because you don't have to just choose one or the other. You're trying to populate a portfolio so that you reduce risk and try to get the highest return for the least amount of risk. And they can obviously both play a role in that. And so when you think about how utilities move against technology, we're showing you a correlation of about 0.26 against the technology sector and 0.22 against the NASDAQ. Now, those numbers may not mean a whole heck of a lot to most people, but a correlation that's low like that is very important when you put them together in a portfolio, because they're moving around at different times for often different reasons.
And you've got a good example, just so people can kind of, to your point, they may not know what 0.22 means, but you have it here at the bottom, TSX versus bonds, 0.18, just which I'll just go ahead and answer this. But in terms of correlation, as we all know, we bring bonds and equities, and we look for those two to be diversifiers, hopefully not tracking each other very well. And so you can start to see that from a correlation perspective, somewhat similar between utilities and technology.
Yeah, that's exactly right.
And then in terms of the standard deviation with respect to, call it volatility, it's a good summary for that. Observations there.
Yeah, you can see the utility sector, again, because they're, let's say, regulated ROEs. A lot of the return is coming from the dividends that are invested over long periods of time. The standard deviation, so how much that thing moves around, is significantly less than technology. So once again, it's not one or the other, but when you combine the two of them, and the fact that they have such low correlations will produce a much more smooth return for client portfolios.
Excellent. Well, Brian, that's a good summary from an investment overview perspective, and I love that special topic again. And even though we said it was utilities versus technology, both, again, back to saying it's not necessarily one or the other, but it's also important not to get sucked into the hype of technology and recognize that that first of all, they're not correlated, and secondly, even from a performance perspective over the long term, utilities do just fine. Thank you very much. Right?
That's right.
So, Brian, thanks so much for this.
Thanks for having me, Mike. It's great.
Folks, as always, if you have any questions, don't hesitate to reach out to your accounting firm financial advisor or talk to your TriCert portfolio manager, or don't hesitate to reach out to myself. Take care.